Let's dive straight into today's explainer on BTC Digital and unpack what might be one of the most extreme, downright fascinating risk-reward setups in the market right now. To really understand the sheer scale of the bet we're looking at, we have to start with the company itself, BTC Digital, ticker symbol BTCT. They're a Cayman Islands-based company, and right now, they're attempting a massive, fundamental strategic pivot. They're trying to evolve from a basic legacy crypto mining operation into a high-demand international AI and high-performance computing developer. Now, you might be wondering, why on earth is a microcap company trying something so incredibly audacious? Well, it's because the economics of AI computing are just so unbelievably lucrative compared to basic crypto mining. They're heavily focused on securing power-ready sites and outfitting them with advanced cooling. Basically, they want to put themselves right in the crosshairs of the AI boom, shifting from just mining digital coins to providing the physical foundational infrastructure for artificial intelligence. And that brings us to the core investment thesis here. We're essentially looking at two radically different scenarios for this company's future, and the gap between them is, honestly, it's awe-inspiring. Scenario A is the legacy crypto miner. They deploy machines, mine Bitcoin, generate some standard cash flow. It's a known quantity, right? But it's a grind. Then you have scenario B. This is where the explosive potential is, the AI infrastructure company. If they can successfully convert their power and data center assets into AI computing capacity, they tap into a market opportunity that just completely dwarfs their historical mining business. We're talking about the kind of unproven, massive upside that really only exists in the middle of a generational tech gold rush. It's exciting, absolutely, but we have to remember that right now it is an entirely unproven blueprint. So the linchpin for actually proving that potential, it comes down to a single number, 10 megawatts. This represents their computing facility in Georgia, which serves as the absolute most critical near-term catalyst. To put 10 megawatts into perspective, that is enough raw power to run thousands of homes, but here it's entirely dedicated to dense computing. Now, back on August 24, 2026, the company announced that construction on this 10-megawatt project was completely finished and rapidly approaching deployment. They're expecting high-performance mining machines to start operations shortly. This physical, tangible infrastructure is absolutely vital, guys. It's the physical proof of concept that validates the very first step of their overarching pivot. And when you translate all that raw power into computing force, the sheer scale really hits you. At full deployment, using their planned high-efficiency machines, this facility theoretically supports 900 petahash per second. To break that down, a petahash is a quadrillion hash computations per second. For a tiny microcap company to theoretically wield 900 of those, that is a real game changer. It completely alters their historical baseline, pulling them out of the tiny boutique operation category and setting a brand new floor for what their infrastructure can actually output onto the global network. Of course, an evolution like this doesn't just happen overnight. It follows a strict four-step infrastructure ladder, and this is what shapes the broader market narrative. You see, the market isn't just valuing them on small-scale mining anymore. They're repricing the company as a potential infrastructure platform. So it starts with step 1, securing the power. Step 2, you build out the data center shell and the cooling. Step 3 is the immediate monetization through crypto mining to get that cash flowing right away. But step 4, that's the holy grail. That's transitioning this exact same infrastructure to support AI and high-performance computing. Why is it the holy grail? Because AI compute commands vastly higher margins. Climbing this ladder is literally how value gets created in today's energy-to-compute ecosystem. Okay, but let's take a step back, because it is absolutely crucial we don't get ahead of ourselves here. Having AI plans is vastly different from having AI revenue. Yes, in July 2026, they appointed a chief AI business growth officer. And yes, management says they're in discussions for AI computing projects. But let's be real, discussions are just discussions. Until this company actually signs definitive customers, secures the outrageously expensive GPUs, finances the massive deployment, and actually shows real profit margins, this entire AI narrative has to be treated as a highly speculative option. It is not banked value yet. If you're watching this space, you have to separate the ambition from the actual cash flow. While Georgia is definitely the main focus, there is a fascinating secondary catalyst brewing up north. They've entered into a joint venture with Aurora Energy for a 5 to 10 megawatt off-grid natural gas-powered facility in Alberta, Canada. This fits perfectly into their whole energy-to-compute strategy. And honestly, the logic here is brilliant. You combine low-cost off-grid natural gas with the naturally freezing Canadian climate, which literally slashes your massive cooling costs, and you get potentially amazing economics. It's a highly efficient formula. But once again, the execution and the financing remain the ultimate hurdles they've got to clear. To really wrap our heads around those financing hurdles, we have to look at the cold, hard numbers. Going back to their December 2025 annual report, BTC Digital had about $2.5 million in total debt, just $1.24 million in net cash, and around 9.5 million shares outstanding. Today, their market cap is hovering around a tiny $5.7 million. Just to put that $5.7 million into perspective, there are luxury apartments in New York City that cost more than this entire publicly traded company. So you have this wild stark contrast between a tiny sub-$6 million valuation and the massive multi-million-dollar capital expenditures required to build international AI data centers.
And because their balance sheet is so tiny, keeping the lights on and building out these data centers takes massive external capital. This brings us to the single biggest, most severe risk facing any prospective shareholder today: the enormous dilution red flag. In June 2026, they entered a financing transaction for roughly $7 million. Look, to raise $7 million when your whole company is only worth $5 or $6 million, you have to issue an absolute mountain of new shares and warrants. And when you flood the market like that, the value of every single existing share gets heavily, heavily watered down.
When you dig into the July 2026 F1 registration statement, the numbers are, quite frankly, staggering. We're looking at the resale of up to 18.42 million shares. That pie gets sliced into about 5.17 million ordinary shares, just under a million pre-funded warrants, and a jaw-dropping 12.28 million shares underlying common warrants. Remember how we just said their historical share count was 9.5 million? This new pipeline means they are basically looking at tripling the share count. Why does this matter? Because even if they perfectly execute this AI data center build-out and become wildly profitable, your slice of the pie is getting drastically smaller. The real question is, how much of that future company today's shareholders will actually own? And this whole situation brilliantly illustrates the incredible uphill battle they're fighting. BTC Digital isn't operating in a vacuum, right? In the Bitcoin mining space, they're up against literal multi-billion-dollar giants like Mara and Riot. And if they pivot to AI, the landscape gets even tougher. They're suddenly competing indirectly against heavily capitalized heavyweights like CoreWeave and Applied Digital. It is a classic David versus Goliath scenario. How does a microcap with a $5 million balance sheet survive against giants with billions? They have to find a highly specific, hyper-efficient niche where their lean infrastructure can somehow make up for their tiny size. Now, despite all these massive risks, there's a reason this stock generates so much speculative buzz. Imagine everything goes absolutely perfectly. This is the bull case, the perfect storm of upside. First, the Georgia facility comes online smoothly and on time. Next, those mining economics kick in and generate real, tangible cash flow. They use that momentum to sign their very first actual AI customers. Because of this success, their risk profile drops, access to capital becomes way cheaper, and finally, the market completely re-rates the stock. It transforms from a microcap miner into a legitimate AI energy platform. If this actually plays out, the upside could be exponential multiples of its current price. But we've got to look at the other side of the coin. What happens if this perfect storm turns into a total nightmare? Under the bear case, the Georgia facility hits unforeseen delays. Because of that, AI discussions stall out. Capital requirements explode because there's no revenue coming in. To cover the shortfall, management gets forced into a death spiral of aggressive share dilution, utterly destroying shareholder value. The narrative shatters, the valuation collapses, and you're looking at a severe, permanent loss of capital. It's harsh, but it's a very real possibility. When we map all of this out on a risk profile, you can literally see the danger zones flashing bright red. Share dilution, execution risk, financing, customer acquisition, the small balance sheet, they are all categorized as very high severity. And they're so high because they feed off each other. A slight delay immediately triggers the need for more financing. Because the balance sheet is small, that financing means toxic dilution. It's a brutal domino effect. Listen, this is not a safe buy and hold dividend stock. It is a highly volatile, highly speculative venture where the risks are extreme and interconnected. Because of that extreme risk, if you're keeping tabs on this space, you need a specific toolkit to filter out the noise. First off, completely ignore traditional metrics like quarterly earnings per share right now. EPS just doesn't matter for a pivot of this scale. Instead, you need to track tangible operational milestones. Watch for the actual confirmed deployment date in Georgia. Monitor the real deployed hash rate, not just the theory. Keep an eye out for press releases announcing signed AI contracts and how they're actually financing those expensive GPUs. And, absolutely most importantly,
Keep a hawk's eye on those outstanding warrant exercises and share counts.
So, how does this all model out over time? This 5-year scenario framework perfectly captures the wild, asymmetric nature of this bet. Look at the spread here. There's a 35% chance of outright failure, driven by financing or customer issues. There's a 40% chance of a moderate outcome, surviving as a small but profitable operator. Then, a 20% probability of strong success, building out a multi-site infrastructure. And finally, sitting at the very end, a tiny 5% chance of an exceptional outcome, a massive rereading that sends the valuation to the moon. Failure is super common here, but that 5% moonshot, that is exactly why speculative capital is circling this company.
Summarizing this into a final analyst scorecard, you really feel the intense friction between the upside and the downside. The growth opportunity, a massive 9 out of 10. The tailwinds for AI are undeniable. The overall risk and reward gets a 7, reflecting that lottery ticket upside. But look at the dilution risk rating, a dismal 2 out of 10. That means the dilution risk is exceptionally high and severely penalizes investors. It is absolutely crucial to understand that right now buying the stock means you are buying a volatile narrative. You're funding a very ambitious blueprint, not a proven, finished, cash-flowing product. Which brings us to the ultimate conclusion of this explainer. The entire thesis for BTC Digital boils down to one single, fascinating question. Can management physically build and monetize the future of AI computing capacity faster than they print new shares? The clock is ticking, the capital is burning, and the answer to that question will dictate whether this is the asymmetric trade of a lifetime or just another microcap mirage. So, what do you think?